This meeting will not be broadcast live. However, a recording will be made available as soon as possible after the meeting has concluded. As always, we welcome the use of the Welsh language at meetings. No requests have been made to speak Welsh today, however, so this meeting will be concluded in English only. Please can members attending via Teams refrain from using the chat function and instead use the raised hand icon to indicate when you'd like to speak. Please remember to keep your microphone muted when you're not talking. Thank you very much. Before we move on to the agenda, I'd just like to welcome Jade Harvey to the committee, to the meeting. Jade's taken over from Geraint Thomas, who was the previous Democratic Services Support Officer looking after this committee. Geraint's gone to work for the scrutiny team, so just if you can put on record our thanks to Geraint for his sterling work over the years, and I'm sure that you'll have an equally good time with us, Jade, as Geraint did. So moving on then, agenda item number 1 is attendance and apologies. Jade.
Thanks, Chair. So I have apologies from Councillor Ting.
Thank you. Everyone else is here, either in person or online, so that's fantastic. Item number 2, Niall, declarations of interest.
Yep, good morning, everyone. If we can start with Councillor Alfie Best.
I have no interests.
Okay, Councillor Gordon.
No, nothing for me, thank you.
Okay, Councillor Hawler.
I'm a contributor.
Okay. Councillor Williams. Okay, and Chair.
Yeah, I'm also a contributor.
Thank you.
Apologies, Chair. I didn't realise that was a thing. Yes, I'm a contributor, sorry.
Great, fantastic. Thank you very much, everyone. Moving on then to agenda item number 3. This is minutes of the Pensions Committee from the 5th of June. This is for members to raise any issues and to agree the minutes. I've got a small one. I'm pretty sure that Chris Tew gave apologies to that meeting. So if you can amend that and put him down as giving apologies. Thanks. Chaps, anything else? John, Carl? No? Alfie? Are we all happy to take the minutes as given? Fantastic. Thank you very much. Agenda item number 4. This is for information only. These are the draft minutes of the Pension Board meeting of the 26th of July 2023. These are for noting only, but as he's here, Ian, as chair of the board, I'm just wondering, was there anything that came out of the board in July specifically you think it would be quite good for us to be aware of? All right, then, fantastic. In which case, thank you very much. Moving on. Agenda item number 5, Audit Wales update. Alex.
Thanks, Chair, and morning all. This report was presented to the Pension Board at their last meeting in July. As I'm sure you're aware by now, we've been reporting for a number of years that there are delays with the audit process from historical times. And this report would typically have been presented at March or at the latest June, but as you're aware, it's coming today in the September meeting. The purpose of the report really is just to set out the audit plan of the pension fund. As you recall, the pension fund is subject to a separate audit to that of the council, although it must be said a lot of the approach is fairly consistent in the way that they conduct it. I think largely the report is there for your information. I would just draw on a couple of points. The first is the financial materiality level. The threshold is set at 37.7 million. That's obviously as a percentage of the value of the fund, which is in the report on page 33 of your papers, 3.775 billion at that time, at the end of March 2023. That's not to say that anything under that value wouldn't be looked at or considered. There are specific areas that the auditors are aware of, but those are the key areas of interest. I think just moving through the report, there are, as usual, some standard significant financial risks. Pages 34 into 35 cover management override. We have substantial controls in place that limit that risk. and the planned response sort of in the document covers the controls that will be tested around that. One area that it has become a bigger factor and will be a bit of a theme across the agenda today is around our private market investments. So this is investing in sort of non-listed opportunities in private credit, infrastructure, real estate, some in real estate. Basically, it's harder to determine a fair value for some of those assets. They don't typically have a market listing price that's priced daily or even weekly. A lot of this stuff is priced on a quarterly or 6 monthly basis, and sometimes even longer than that. And there are a lot of assumptions that are factored into those valuations. Obviously, from an audit perspective, they are very keen to understand what assumptions and methodology goes into that process so that we're not overstating the value of our assets in the fund. As we've committed more and more capital to these investments and that capital has now been drawn down, the value of the overall investment has exceeded the materiality threshold I mentioned. And so, as I say, it's part of the testing process. From an officer perspective, we work closely with the investment managers who manage these assets for us. As the specialist, we would expect them to provide the rationale for their fair value methodology, but clearly we have a role in ensuring that that's appropriate. So that was a main area. I think there was one other point I just wanted to touch on, which was one of the new accounting, the accounting standards that are being deployed is the ISA 315. This largely focuses on risk identification and focuses on areas such as IT. I've worked with the Council Section 151 officer and the head of finance on responses to these questions, which we've provided to Audit Wales. As I say, it's looking for more clarity around the control measures in place to manage these sorts of risks. There are other points of information in the report around fees. As you'd expect, fees have increased in line with inflation. The audit team is fairly static in terms of the engagement director and the manager. There has been some turnover in terms of the role of the audit lead, which we're pleased to say that one representative in particular has worked with the Swansea Pension Fund and other LGPS in the past, so that's helpful from an experience. In terms of timescales, we are still working through the audit. I hope that by the end of this month we'll be pretty much there with that, but we do have some scope with the deadline for publishing the approved report being 1st of December that we'll have everything in place. One thing that perhaps an action to take away today is to agree a date in November for a special pensions committee meeting just to consider the final version of the annual report and the audit report, which hopefully by then will be concluded. So we'll take that away and circulate some dates for a meeting around mid-November. I think that's all I wanted to pick up on the item, Chair, but happy to take any questions.
Okay, thank you, Alex. I think obviously the reading of it is very much a statement of intent here from Audit Wales about the process and what they're going to do. So there's not too much for us to consider in the actuality of it. David.
Simply a question. Given that a significant amount of investment is pulled together in the Wales pension pool, do the Audit Wales audit them as well, or do they simply audit all the constituent bodies?
No, that's a great question, and the answer is yes. The Wales Pension Partnership are subject to a separate audit, and that audit actually has already taken place. And because it's effectively a joint committee, the audit requirements of the WPP is slightly separate to the pension fund. But that being said, they do produce an audit opinion on the WPP statements and annual report as well. I can certainly share a copy of that update if it's helpful.
I think it was more just a sort of question because obviously there's a great materiality of what's actually included within there, and we want to be sure that process is also being looked at as well as what process exists for ourselves. So thank you for the confirmation. That was sufficient.
Thank you very much, David. Members, any other questions on what Alex has outlined? We'll come to it later, but presumably people are happy to have a notional extraordinary meeting in November to discuss both this item and the following item, in which case I'll work with Alex and circulate some dates after the meeting. Thank you. as if by magic then, item number 6 is the other item for that meeting in November, which is the draft annual report and accounts for 2022-2023. I think before I bring Alex in, I just want to thank to everyone involved in the preparation of the report. Obviously, it takes an awful lot of work on behalf of the staff to prepare these every year. Yes, and the other note I made was that we will have an extraordinary meeting in November to discuss it. All I would say maybe to Alfie, as definitely as the newest member, but then the rest of us, basically, apart from John, are all still relatively new members. It actually does, I thought, reading it with the narrative sections at the beginning does provide quite a good snapshot of exactly where we are and what the committee is up to. So I think it might be something to keep, not necessarily next to your bedtime reading list, but it is something we can refer back to in terms of what the committee is up to. Alex, anything you'd like to raise?
Not too much in terms of the detail, to be honest. I think, as I say, the appendix covers the full extent of the annual report, which is still in draft form. The auditors, as part of their work, so I should have said that the pension fund accounts sit within the body of the annual report, and that's one of the primary areas that the auditors are focused on. But what they also do is review the annual report detail and make sure that cross-references really. And we have had some comments on the draft annual report, which we will look at and revise as we need to. And as I say, the final version that's presented at the meeting to be agreed in November will provide a final version for any final comments.
So presumably if members have any questions or observations on the text of the draft report, they can send them in to you and they can be considered between now and the final signing off date. Notionally, any date that you'd like to have any comments back by?
I think any comments back by the end of this month, ideally, because I think obviously the final work that Audit Wales will be carrying out, if we have to make any changes, that would be the optimum time to do so before we finalise the audit.
Okay, thank you very much. Okay, so members, any questions off the back of the report as presented? David.
Thanks very much. It was interesting to the observation was that there's still increasing the number of pension members, which, you know, at the time of decline of contraction, if you like, of many bodies is interesting. I guess there'll be a point when it passes and we have more people being paid than actually active contributors. That's just an observation. The second thing was really on page 125 in the admitted bodies. Are we anticipating some changes there? Because I'm conscious that some of the bodies, like housing associations, are reviewing their position vis-a-vis the Greater Gwent pension scheme. It's helpful, I think, perhaps to know of any movements that take place within that as part of the annual report overview, maybe.
Yeah, good question. I think on the admitted bodies, and just for members' benefit, this is typically these sorts of employers get access to the LGPS because they provide a local government service, and from historically a lot of sort of local authorities and other bodies such as housing associations may outsource sort of a catering or a cleaning contract or another service where a to-be transfer of those staff are involved. So that's typically how they exist in the scheme, and you'll see from the list there are some education bodies, as I say, cleaning and catering companies are quite common, as well as sort of the leisure trusts that have borne out of local authority over time as well. There typically is a little bit of movement. We're not exposed to some of the significant changes that happen across the border where academy schools exist. That can trigger a lot of activity on admitted bodies because each of those academy schools then outsource contracts and increase the scheme employer member. In terms of this fund at the moment, it's fairly static. We are having conversations with housing associations, as with some other bodies, around long-term affordability. That typically is an ongoing piece of engagement. We did a lot of that work as part of the valuation last year, and that's continued. I think, as I reported previously to this committee, there are some increasing flexibilities that the LGPS has in terms of offering support to employers around how they sort of meet long-term deficits and things. So, as I say, there's nothing sort of significant really at this stage to report on in terms of change, but there are sort of periodic changes that could occur, and I know Joe has some discussions with employers around new bodies that typically are contractors.
Thank you, Alex. Any other members? Any other questions? Okay, moving on then. Thank you very much, everyone. Item number 7, back to Alex again. This is the quarterly update from the Wales Pension Partnership.
Thanks, Chair. Yeah, another quarterly item. Hopefully members are familiar with the structure of this report by now. What we try and do here is capture activity that's taken place as part of the WPP, the Wales Pension Partnership, over the last quarter. There is a reporting lag on this. The last meeting of the JGC took place on the 19th of July, and the substance of those updates reflected quarter 1 in 2023, which was the 31st of March. So some of the numbers are now quite out of date, but it's just the nature of the reporting lag. In terms of this update, we always provide an extract of the JGC minutes, which captures the key decisions. To be honest, a lot of the really pertinent items find their way onto these agendas in one form or another, given their importance. So that's there for information. I think at the top of page 154, another core part of the JGC agenda is the operator update. Link Fund Solutions are still the operator for the contract and have been since the formation of the WPP. And sort of in paragraph 5.3, there's an extract there which gives a snapshot. And these are more up-to-date valuations given the reporting like I just talked about. So to the 31st of July, you can see the valuations against each of the 8 sub-funds now that the Greater Gwent Fund is actively invested in, some of which date back to 2019. So you can see the progress. I think two points I would pick up on this particular page is the launch of the Sustainable Active Equity sub-fund. That did go ahead in June and into July, which is really pleasing. The fund made a commitment of 150 million to that, and so the valuation at the end of July is there or thereabouts, which is pleasing. There has been a bit of a pause over the summer period with some of the WPP agenda just due to annual leave, but we are due to receive a report on the outcome of that transition, which is a useful governance exercise really to make sure that the process was managed as well as it could have been. Quite a lot of cost involved in moving money from one portfolio to another, so that's something we always look at and try and pick up sort of lessons learned, I suppose. The other point to bring up is the global infrastructure, so that's the line just above in paragraph 5.3. As I've talked about a lot through the agenda over the last 12 to 18 months, private markets is a big priority for the WPP, as it is for the fund, and we made investment commitments to 3 products in the last 12 months, which is the WPP Private Credit, the closed and open-ended infrastructure funds. And in the quarter that's just gone, we made an initial 9 million commitment to the closed-ended infrastructure fund. So that's good. That's sort of we knew that obviously with it launching in May that we would start to make commitments, and that's obviously already happened. So pleased with that. I think the only other point to really raise, as I'm sure you're aware and has been reported in prior quarters, that Link Fund Solutions, who are the operator of this contract, have sometimes been subject to acquisition, and various takeover proposals have failed or fallen by the wayside. But one that has materialised is the acquisition by Waystone Group. I reported in the prior quarter that is in exclusivity now and going ahead. I think the target is that will all transition by October. And actually, from a fund perspective, we've considered and signed some legal documentation that sort of ratifies all of that process as well. So that's really helpful in terms of the continuity for the WPP. We are going through a procurement process as well because of by December 2024, the current contract we have with Link, which is being novated to Waystone, subject to the final approvals going through, will run just over another 12 months to the end of December 24. At that time, we will need a new contract, and the procurement process is well underway now. So I think that was the sort of the substance of the update here, but I'm happy to take any comments or any questions on any of that.
Okay, thank you, Alex. Members, any questions or comments of what Alex has said? David, Alfie? No? I mean, only one extra thing for me to add, and I know we might come and to discuss it to a certain extent in the closed, under the closed items later on in the meeting. We've got a virtual meeting on Wednesday with the rest of the members and the officers from the constituent authorities and the WPP to have a conversation about the government's consultation into pensions pooling. We can update everybody on that after we have the meeting. Okay, if that's it then. Thank you very much, Alex. Although it's still you for the next one. So that's the finishing agenda item 7. Moving on to agenda item 8, and that's the quarterly investment performance report. Alex.
Thanks, Jay. You'll all be pleased to hear that I'll delegate some of this update to our advisors as well, so you hear some different voices. I think really just the key points from me, which are captured in the key messages on page 177. As ever, there's a reporting lag of a quarter here. So this report takes account of the performance to the 30th of June. That's quarter 2. We are midway through the final month of quarter 3, and in December you'll receive an update which will cover to the end of September. In order to plug some of that gap, I'll invite in a second Ethan as our advisor to comment on the macro so that you can get a feel for where we are at the current time. I think key points: positive return during quarter 2, funds up just over 1%, which is consistent with the benchmark. Obviously, long term, we're trying to outperform the benchmark with many of our mandates, but I think in short-term periods, keeping pace with it is a minimum, so that's pleasing. That translated to around a 52 million increase in the value of the fund through that period to just shy of 4 billion now, 3.8 billion. Long-term performance, that's something that I always encourage everybody to think about, really. Obviously, we're funding long-term liabilities for decades to come. Long-term performance still is ahead of benchmark on all time horizons. That's a 3, 5, 10, and since inception, which is dating back to the 90s. As a reminder, the actuarial part of the funding approach that the fund takes is to set a long-term target performance return, which the actuary believes would be sufficient enough to meet the liabilities of the fund, and that's just over 4% as of the valuation in 2022. So looking at those long-term time horizons of 6.96% through just over 5% and 7.5% and then 6% since the 90s is comfortably above that long-term assumption, and that really is critical to us closing what is now a relatively small funding deficit of a couple of percent. But in terms of making this a more sustainable fund in the long term, we're targeting sort of 110% plus funding levels, ideally, to get us there. So that's really positive. I think at that point, unless there's any comments, I'll invite Ethan to make some comments on the market, and then perhaps Betty will comment a little bit more on some specific points that she's picked up as part of our routine quarterly monitoring.
Great. Well, it's great to be here in person for a change, and very happy to discuss what's been a surprisingly resilient year in markets, and I'd say in your portfolio too, notwithstanding that the performance may not look as strong perhaps as it has looked in previous years in absolute terms. So why is this context important to you? Because you have this globally diversified portfolio with currencies in that portfolio beyond sterling. It's key to look at the performance around the world and remind ourselves as to why we are diversified as we are. The diversification is there not just for the risk that you expect to happen, but for the risk that you do not expect to happen. And what perhaps was not expected in this last period was just how resilient certain economies were in the post-COVID period. So the resilience really has come from the US. Even though the dollar weakened a little bit in this time that you were capturing performance, it has continued to be very strong and surprisingly strong, well above where it was, really close to a 20-year high. Why is that important for you as a global investor? Because a lot of your exposure is in dollars. So when you have a dollar as strong as it is, you get that additional boost. By the same token, when the dollar is weak and you're a sterling investor, you're reflecting your absolute term, your pension fund back into sterling, that will be an additional drag on the performance. So currency performance is important. What has been the surprise of 2023 has been how resilient certain economies have been. I spoke about 2022 as being kind of a good disastrous year for bonds and equities, but 2023 has really been a comeback kid of a year. It has not shown that recession come through that was widely anticipated, and that has been a surprise to many. We've been wondering why these economies have been so resilient in the face of unprecedented rising rates. In the UK, there have been 14 consecutive rate rises, and the US, 11 out of 12 decisions have been to raise rates again. Inflation has remained high, but is definitely turning a corner and coming down, in some places in a more accelerated way than others. I had a recent call where someone described inflation as being like an Eiffel Tower. If you think of it, a very steep incline, but equally followed by a very steep decline on the other side. And that's certainly what we've seen in the US in terms of inflation. The UK has been remarkable in perhaps not participating to the same degree in that resurgence of equity market strength. So even though the UK has seen the same rises in interest rates in response to high inflation, the market has not participated in the same resilience that we've seen elsewhere. There's a chart on this page showing just market performance in the US, Europe and the UK, and the UK has been very flat and I'd say almost stagnant in the face of some of the other market strength. Even Europe has been remarkably strong compared to the UK. Asia, of course, and China have had their own issues. And why is the UK like that? Partly it's because of the inability to participate in some of the large tech hype. It is kind of an older economy type stock market, the FTSE, more exposure to financials, which are obviously still clouded by this rising rate environment, and some of the difficulties in the financials in the US, for example, a little bit of contagion for that. We still have this overhang around some of the fossil fuel companies and the older economies such as mining, and there just hasn't been that participation in what has essentially been a hype cycle in the US around tech. If we look at there's a chart in here showing just not only how much AI and generative AI and other technology names have popped up in every company's discourse in terms of their earnings, etc. And there's another chart showing just how much those top 7 tech stocks have really contributed to this resilience in market and the 20-30% increase that has been there. So the question is whether that is a hype cycle that could ultimately peter out or whether it is to be sustained. There is some belief that this is not like blockchain or Bitcoin, that this is AI is here, will change our lives, will change how we work, will change how companies make money, and there is some evidence that this is likely to be sustained. So staying out of the US or staying out of tech at this point would probably not be advised, in that there is every likelihood that strength in markets will be sustained going forward. There are certain other indicators that the consumer just remains extremely strong. The employment rate remains extremely high and the unemployment rate extremely low. Usually when that's the case, that tends to shore up a consumer. And as long as the consumer is still spending and still employed, that's every indication that the economy will stay strong. Equally, the consumer has been saving a lot since COVID, and that those savings we can see in the money market funds, for example, of the US, or the savings accounts you have over here. And those savings accounts are still relatively strong compared to what you would expect to see if we were entering a recession. Therefore, that's likely to support markets going forward. So all in all, it has been unwise to bet against traditional equity markets today. We've still, with these higher rates, we're also seeing meaningful returns in fixed income. And I suppose the only sectors that look impaired today that we would question might be something like real estate, whereas it's a more of a longer dated asset class. We're still not really seeing the fallout from much of the shifts post-COVID around working. And there's even some evidence to suggest that that's kind of been reversed. In some cases, we're seeing a lot more return to the office. Still a change in how offices are used. So there's still a question mark over some of those asset classes. But overall, your strategy of having a well-diversified portfolio globally with exposure to bonds, exposure to equities, that has still been very much making sense. The only last thing to point out around directions of travel and rhetoric and what's happening in markets, you may be aware that there has been a bit of pushback around ESG investing, around some of the engagement, the level of engagement that's happening with companies around the energy transition. Large players such as BlackRock, you have that in your portfolio, have indicated that they won't be engaging to the same degree, that they're retiring the terminology ESG. I think we have to not kind of just look at the headlines here and look at what's really behind it. Clearly, this has become a weaponized term, and there have been some concerns that engagement is not effective. And every time we look at an engagement report, we always say, well, okay, where is the actual evidence that this engagement is making sense, or that, you know, there's actually results attached to it. So engagement has to show results for it to be effective long term. And if an engagement is not commercially viable, there's every evidence it won't see results. So I'm not sure that the BlackRock pulling back from some resolutions is necessarily a retrenchment. More, it's a sign that there's a focus on, well, what kind of engagement is efficacious, and we'll see results. So I think that's actually a maturing of this ESG trend more than any kind of a rolling back of the initiatives. But it will evolve, will become more nuanced, and ultimately there will be a need to make it more commercially compatible in order for companies to get on board. So I'd say we are at a juncture here with we've discussed our focus on our carbon footprint and the carbon exposure of the portfolio. All of your peers moving towards more net zero commitments, as well as we've talked about climate solutions already. None of that has to stop, but I would suggest that we're going to see an evolution in how this is expressed. It's not likely to be expressed perhaps in the same language as it was before, but I think that the thrust is very much still in that same direction. But we will see a little bit of refinement and narrowing perhaps of some of the objectives there. So as we look to the end of the year, clearly we are not pleasantly surprised by where we are at this point in the year. I'd say we are going to look at inflation. We want to see that continuing to come down. We want to see central banks with their response be more, I suppose, reflective of the fact that there's been a lot to digest with these 14 consecutive rate rises. Clearly, the consumer will have a limit to their resilience, and we'd like to see that that limit is respected and not pushed over the limit, so that we don't see defaults, more distress. Clearly, with some of these company announcements suggesting that there's more shrinkage, more theft, essentially, in retail, clearly there are some consumers doing better than others, and some consumers have been pushed to the brink. So that's what we're keeping an eye on, and continuing to keep an eye on on that ESG approach, as we mentioned. So happy to take any questions or after the portfolio impact has been discussed.
I've got some, but members, any comments or questions from you guys first?
Yeah.
So Alfie?
With the rolling back of language used for ESG, is it just that the term is associated with lower growth, and so that they're not using the term as much, but continuing, the responsible investment, or is it that they're actually rolling back their responsible investment to move away from that ESG?
Mine's on a similar line, so if we take them together, I think, could you just essentially talk us through what BlackRock are proposing to do instead of actually using their current ESG framework? Because that would be quite interesting to get our heads around. But I've got a slightly related question. Looking at your predictions on page 196 of the report, and issues about what potential consequences of moving away from ESG as a thing within the UK. If we're looking at some of the conversations that are being having at a UK national level, both the government and the opposition at the moment having a bit of a ding-dong about it being seen that we're being a bit too woke to be talking about these environmental issues, and I look at the scrap of ULEZ in London as the perfect example, is there any suggestion that if there is growing uncertainty over the commitment to a net zero ESG framework coming out of the UK government, do you foresee that might cause turbulence in terms of the markets? Definitely looking at some of our investments looking into next year. That was a bit of a jumble, but hopefully it all makes sense.
Sorry, is it now? Yes. Oh, should I? Well, I won't repeat the whole thing, but let me talk. I'm sorry. Let me talk about risk. So in terms of the risk, there clearly is a risk to a portfolio with climate risk. So not having that is not having an awareness of climate risk and its impact on a portfolio is damaging potentially to our portfolio going forward. So everybody, I think, is aware of the need to have that in place, have a structure in place that is around sustainable investing. And there's also a sense that who would not want to have a sustainable portfolio? So I think that ship has sailed in terms of this being the way to prudently invest in a risk-managed way going forward. As far as where is the direction of travel with government, in a sense, this has been both a private and a public initiative. It can come from policy, but we've seen this through many of the COP meetings in Glasgow and Sharm el-Sheikh, that in a sense this has to be privately oriented. And it was the likes of BlackRock that were actually at the forefront of pushing for change. And in a way, policy was behind. So I would think that this has now been taken into private hands, primarily because the likes of BlackRock are getting stakeholder pressure to continue to make change and not turn back. So that stakeholder pressure is driving the private initiative, and I think that will continue to drive the return. So whether the government is less committed to its local impact levelling up or to its impact, I'm not sure that really matters anymore because the private thrust is coming. Now, as to what BlackRock itself is actually doing, we should ask them that. We should get it from, this is a very dynamic area. This statement by Larry Fink was 2 weeks ago in terms of retiring the term ESG. Similarly, the statement around not backing as many shareholder resolutions because they're seen as too prescriptive, which is what he said. That, again, was a recent statement. So we'd like to know what that means, but I don't take that as really retrenchment, more refinement of the terms, a desire to evolve, to avoid the weaponizing that's going on. And it's true that there will be some states in the US, like Texas, Florida, that will not want to will still think that ESG means sacrifice of return. But I think we're increasingly seeing between your investments in sustainable energy, sustainable stocks that are focused on this, climate tech, the energy transition. There's so many money-making opportunities that are very compatible with this focus.
Yeah, thank you, Ethan. Betty.
Yeah, hi. Just to add a little bit to what Ethan said, while BlackRock may not be covering themselves in a banner with 3 letters ESG on it, in today's FT on the front page it says that BlackRock is the 3rd largest shareholder through all of the funds it manages in Glencore, has voted against the company's climate alignment plan, thinking it's insufficient. So while they may not be jumping up and down and making a public song and dance on an individual company by company, they are still putting pressure on management to go faster and just raise the bar every time rather than lowering the bar. And I think this also tangentially points to why it's so important to engage and actually vote against management rather than just divest if you really want change. This is the page 8 of the FT. It's on one of the little briefing stories, and it was also covered briefly in the news today. And so I think it is very much more case by case as opposed to making blanket statements, which tend to kind of, rub people the wrong way sometimes.
Okay, thank you very much. I think over to Betty now, and were you going to give some more colour about your report?
Oh, yeah, just very brief, I was going to just make 2 points. And Alex mentioned initially, you see the overall performance was down by about 0.5%. I would just remind you that a portion of the assets are actually not in sterling. Sterling appreciated by 2.5% versus the US dollar over the quarter and by over 4% year on year. So while this doesn't affect the relative performance versus the benchmark, I think when you see a negative, very slightly negative performance, you also need to remember that some of this is also translated back into sterling, which appreciated over the quarter. So it doesn't mean that your assets really lost money. It's just that it's an accounting thing, how you then translate this into sterling, which bounces around. And just to bear that in mind, I think this is a topic that we do need to focus a little bit more and make a bit more, break things out a bit more to be more transparent about this. One more thing, I would say that anything, whether it's real estate, whether it's bond portfolios, where valuations are linked to yields, have had a tough year over the past year with all these rate rises and things, and there's no way of getting around it. But I used to work on trading floors, and you can't look backwards. You need to look forward. You could look at the rise in yields and the adjustment in price that followed as just a sunk cost. You have to move forward and not look at the pain you suffered, whether it's in your bond portfolio, your real estate portfolio, whatever. It's going forward that matters.
Okay, thank you very much. Any further comments, queries? David.
I noticed on page 192 you mentioned the sort of, if you like, the sort of change with India becoming more marked, perhaps. Do you see that as a trend that's sort of continuing, given some of the difficulties that seem to have been happening in China?
Yes, very interesting question. And the reason I put it there is because we've talked for some time about the whole emerging market conundrum in the last few months, years, because it's underperformed developed markets really for 15 years, which is the longest streak. Why is it in the portfolio? Why was it in your portfolio? Well, as a source of global diversification growth. A little bit of this diversification against the unexpected, that we never know when that's going to reverse. So we kind of we try to keep a finger in all pies, so to speak. It was there because of its potential for high growth, which it doesn't always display, and certainly not recently. And then there was the whole ESG question mark around the likes of China and ESG in general. But whether, as we had an increasing, I shouldn't use that term, but as we had increasing focus on risks relating to social and governance factors, were these emerging market companies going to measure up? So we would have been focusing, certainly Russia tripped that concern, and now China with some of the focus on human rights violations, etc., as well as its own carbon transition plan. So China's been under the microscope for some time. It's also been a very poor performer. And I speak to a lot of emerging market managers all the time, and everybody is excited about India. It's seen as being the new, more stable, slightly more identifiable democratic process there, as well as always seen as being very similar to China in terms of its growth trajectory. Now, as you can see from the comparison, the population's the same, but it also has a much greater, low-hanging fruit component, which is that the non-consumer class that could step into the consumer class. So I would suggest we're going to see more in the emerging market portfolio, more exposure to India, less to China, and especially as some of China's regulatory oversight and other just messy fallout from post-COVID continues to drag its performance down.
However, we did actually query Russell, who manages the emerging market through WPP, recently, just last week on that. And while that story is, very compelling, a lot of other people think so too. And so their comment was that right now prices are very high in India because it has, has gathered so much attraction. So there's also the investment discipline of how much you pay for something which is attractive, which must be maintained.
Okay, thank you very much. No other questions. Thank you very much both. And we'll move on to agenda item 9, give Alex's vocal cords a rest. Over to Joanne.
Thank you. There was only 2 areas of this report I wanted to draw your attention to. The first part was the My Pension Online statistics. So, as you'll see...
What page is that, Joanne?
Page 221. So I'm pleased to say that the number of members registered for My Pension Online has increased significantly within the last quarter, with just over 2,000 members registering for My Pensions Online, bringing the total then to just under 30% of our total membership signed up to use the service. The increase has been as a result of sending out annual benefit statements to members and asking them to register on My Pensions Online to access their statements, as well as their newsletter. So I'm pleased to see that increase, and hopefully we'll see further increases now throughout the year, and then once again next year when we send the information out again to our members. But it is our commitment to get the numbers registered on My Pension Online to increase. And the only other thing I wanted to draw your attention to is this week is Pension Awareness Week. It's an industry-wide event which is taking place this week, and it's trying to get members to pay attention to their pension. And as part of this, for the first time this year, we're holding a session for Torfaen staff who are in the LGPS pension. That's being held on Wednesday. It's had a lot of interest. We've had, by the end of play on Friday, there were 63 members asking for individual appointments with our benefits team to go through their pensions. And I know we had another mail shot out this morning, and those numbers are increasing again today. So I'm really pleased and looking forward to this event on Wednesday. And this is hopefully something that we can roll out to our other local authorities and other employers next year, when this Awareness Week is held again. So I think it's very positive with the engagement that we're carrying out. So that was all from me.
Okay, thank you very much. Any questions on Joanne's comments or the wider report? No? Chair's prerogative, as we've got you in the hotspot, was that a yes, David? So, David.
It was only to say that I think it's a very welcome initiative. So,
yes, and let's hope that too many members don't decide to go for early retirement off the back of the consultation this week. As we've got you in the hotspot, I'm going to suggest we move on to item number 11. Take the training item now, and then we'll come back to item 10.
Okay, thank you, Chair. So members will be familiar with this report. Basically, it sets out the training log for last year, and also sets out the annual training programme for the current year. If any information on the log's incorrect, please let me know. And also just a reminder about any training events. If you want to attend any training events that you've identified, then please let us know and we can have a look into these and have a look if we can arrange them for you. Thank you.
Okay, thank you very much. So I know we all, those of us from the committee last year had the fundamentals training. I think I didn't manage to get to do all of it, so I've definitely put in my diary the dates in October, November and December to redo the entire exercise, because I think, quite frankly, there's a lot of information there. It's quite good to have the refresher. So I think I'll probably end up trying to do those. The October one I might have to do online, but I'll see if I can make the events in either London or in Manchester in either November or December, and I'll let everybody else know in case anybody else wants to take part in the same session. Other than that, everyone happy? Yep, okay. Moving back then to hopscotching about. Item number 10, Alex, the risk register.
Thanks, Chair. Just a couple of comments to make on this report. As members should be familiar, this is another of the quarterly items that come through. We've worked quite hard with the board, really, and the local pension board have contributed significantly to the evolving nature of this report and the appendix over the last 12 months or so. The cover report is largely consistent, and I say that because there are, as a part of the changes that have been made, there's no change in the approach to the way we monitor or report risk. The way in which we monitor risk, just in the way in which we have reported on it. So historically, we've had quite an extensive document, if you like, that's got sort of 40 risks covering finance, investment, admin, and the governance affecting the scheme. I think really through more of a detailed discussion, it's quite clear that there was perhaps too much detail really for members to digest in one meeting and even over a couple of meetings. So what we proposed to do was essentially two-tier this report with a strategic section covering what we perceive to be the most significant risks across the spectrum, covering all of the functions we carry out. And then to continue to monitor as officers, advisors, and at least annually members is the operational risk, which covers the sort of 30 other risks that no longer appear on the document in the appendix. So that change was made perhaps 6 months ago now. We've gone through a couple of reporting cycles, and I think it seems to work, and feedback from the board is that this is easier to digest. So hopefully members of the committee agree. I think in terms of this update, and this went through the board in July, there were two risk changes really proposed. One was that as part of the transition from initially just one tier of risks, i.e. those 40, to a two-tiered structure with strategic and operational. One risk had fallen through the net, really. We felt that it needed to be on the strategic register, and that's now been added as SR9. There was also a comment from the board during a prior meeting about expertise, knowledge and skills. I think that risk was largely picked up as part of the transitional effect of the former head of pensions retiring, and sort of a period really where we were undergoing some transition, some change there. So, but I've been in post a couple of years now. We are a much more stable team and a growing team as well. So we felt that risk could be justified, a risk reduction could be justified there. So they were the two changes. As I say, the appendix there is for information, and I'm happy to take any comments or any questions on that item.
Thank you, Alex. I'd just like to say I think the members appreciate the fact that we pared this down on the cycle. It's easier to digest and work on some of the specific risks you want to highlight in any given quarter. Now, because of the nature of today's meeting, and we have gone through in a bit of a clip because we wanted to get to the closed session after agenda item 14, I did ask members last week if they had any specific questions on any of the specific categories to either notify Alex or myself, and I didn't receive anything. So unless anyone's got any questions off the back of what Alex has just said, or no, in which case, thank you very much. Taken as read. Moving on to item number 12, which is the date of the next meeting. This is for noting only it's the Christmas meeting, so that's on the 11th of December 2023, and that's come round very quickly this year. So we can all pop that in our diaries. Like I said, Alex and I will have a chat after the meeting about suggesting a date to this extraordinary meeting in November, so we can sign off the audit, the annual report, and potentially note some of the decisions that might arise off the back of the discussions we're having in the closed session. So if everyone's happy with that, here we go, the testing bit of the day. Right, agenda item number 13, exclusion of the press and public. So I'd like to ask the committee to agree the exclusion of the press and public from the meeting, as presentations and meeting papers are not for publication, because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, open brackets, as amended by the Access to Information Variation Order Wales 2007, close brackets, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest in disclosing the information. Are members happy to go into closed session? Yes. Thank you very much. Niall, could you turn the recording off, please?